Meet Brian. Brian is buying a house. He needs a $400,000 mortgage, meaning he's about to sign a stack of paperwork binding him to 360 months of rigid, unyielding payments. This chart compares the exact same loan on the exact house, just a few years apart. If Brian signed these papers in January 2021, his monthly payment would be $1,612. If he signed them in October 2023, that payment jumps to $2,877. Over the life of the loan, that timing creates a $455,000 difference. You might think Brian's local bank decided to charge him an extra $500,000, but they didn't invent that price hike. The Federal Reserve didn't pass a law mandating it. The single largest expense in a normal person's life is actually dictated by a $145 trillion machine most people have never looked at once in their lives. That machine is the global bond market. Inside that market, one specific number matters more than any other: the 10-year U.S. Treasury yield. The United States government borrows more money than anyone else on Earth. The total national debt is sitting at around $39 trillion, which is a number so massive it loses all meaning. So consider the interest. The government actually spends roughly $1 trillion every single year just on interest payments alone. This directly affects Brian because of a simple calculation every bank makes. Why would we lend money to a regular person for 30 years when we could lend it to the U.S. government for 10 years, risk-free, at a guaranteed rate? The answer is they won't. You have to pay a premium above that government rate to compensate for the risk that you might lose your job or get sick. Understanding your salary and bank account offers an incomplete picture of your finances. Your mortgage, your car loan, and your savings account are all downstream of the bond market. Look at this structural breakdown of a standard bond contract. A bond is just a loan. You hand over a fixed amount of money, called the principal. In return, the borrower promises to pay you a fixed interest rate every year, called the coupon, and they promise to give your original money back on a specific date, called maturity. To understand the market, there is exactly one rule you must memorize. When new interest rates rise, the price of existing bonds falls. They move in opposite directions, every time, without exception. Suppose you buy a $1,000 bond paying 3%, which gives you $30 a year. Months later, the government issues new bonds paying 5%, meaning $50 a year for the same upfront cost. If you want to sell your old bond, nobody will pay you $1,000 for it. You have to drop the price until your $30 payout offers a competitive 5% yield. Mathematically, that means your bond is now worth roughly $600. If you hold that bond to maturity, you still get your $1,000 back. But in the meantime, the on-paper value of your investment has crashed. When that specific math problem scales up, it causes global financial disasters. In 2022, the Federal Reserve raised interest rates faster than at any point in the last 40 years. That sudden spike forced the iron rule to apply to millions of retirement portfolios all at once. For decades, financial advisors sold the classic 60-40 portfolio, 60% stocks, 40% bonds, as the safest default for retirees. Bonds were supposed to be the protective seatbelt.
Instead, because existing bond prices collapsed as rates spiked, the safe half of the portfolio crashed right alongside the stocks, wiping out about 16% of its value in a single year. The severity of those losses comes down to a technical metric called duration. You can think of duration as a multiplier. It estimates how much a bond fund will lose for every 1 percentage point that interest rates rise. If you own a fund with a long duration, a standard rate hike translates directly into stock-like losses. To put that in perspective, a Santa Clara University analysis found that 2022 was the worst year for long-duration U.S. bonds, going back to 1754. America's safest retirement assets saw their worst performance in 268 years, a time when the country was still 13 colonies. The reality of the bond market is that the word safe only means the borrower will eventually return your principal. It offers zero protection against your net worth collapsing while you wait. Rising bond yields also poisoned the stock market at the exact same time in 2022. This chart breaks down a concept called the equity risk premium. It represents the extra return you demand for taking on the high volatility of stocks instead of just sitting on a guaranteed government bond. Watch what happens to the math. As the guaranteed yield rises, it squeezes the premium you get for holding stocks.
Eventually, the gap gets so thin that the risk is no longer worth it. Investors sell their stocks and rotate their cash into bonds. The bond market acts as the baseline gravity for finance. When government yields rise, they mathematically drag the price of every asset down with them. The bond market actively prices the future through a chart called the yield curve. This graph plots the yields on U.S. Treasury bonds across every maturity, from 3 months out to 30 years. Normally, you require a higher yield to lock your money up for 30 years than you do for 3 months. That extra compensation creates a healthy, upward-sloping curve. But occasionally, short-term yields spike higher than long-term yields. This is an anomaly called an inverted yield curve, and it happens when the market anticipates an economic slowdown so severe that the Federal Reserve will be forced to cut rates. When this specific inversion happens, the bond market is sounding an alarm. According to the Federal Reserve Bank of San Francisco, every single one of the last 10 U.S. recessions, going back to 1955, was preceded by an inverted yield curve. That is a 10-for-10 record over 70 years. Bringing all this macroeconomic theory back to Brian's wallet reveals a massive gap. Right now, the national average savings account at a major bank pays a microscopic yield of 0.38%. Meanwhile, a 3-month U.S. Treasury bill pays nearly 10 times that amount. Both instruments carry identical government-backed safety. The only difference is which institution holds the cash. Leaving significant money in a standard bank account means volunteering to lose thousands of dollars in uncollected interest. And if you are holding bond funds to capture that yield, you have to check their duration to avoid stumbling into the exact trap that wiped out retirees in 2022. The bond market represents the underlying source code of your daily life. It prices your mortgage, prices your savings, and your retirement. To protect your wealth, you simply have to stop pretending it's boring.